Hello, everyone. Welcome to the market opening bell on Friday, August 15th, your 10-minute guide to the stock market. Hong Kong stocks opened higher but closed lower on Thursday. The Hang Seng Index surged 152 points to a near four-year high of 25,766, but later fell 163 points to 25,449, ending the day down 94 points or 0.4% at 25,519. The Hang Seng China Enterprises Index dropped 21 points or 0.2% to 9,128, while the Hang Seng Tech Index fell 54 points or 1% to 5,576. Total market turnover was 270.1 billion Hong Kong dollars. Southbound funds net purchase $1.034 billion in Hong Kong stocks, with net buys including China Life Insurance at 1.353 billion, Alibaba 455 million, Li Auto 352 million, 3S Bao 304 million, Ecoso 222 million, and SMIC 161 million. Net sales included Tencent at 1.197 billion, Meituan 386 million, XDelPi 254 million, and WuXi Biologics 188 million. Southbound funds have net purchased Xiaomi for 6 consecutive days, totaling $3.372 billion. Technically, the Hang Seng Index briefly broke above the July 31st high of 25,736 before retreating, forming a typical double top pullback pattern. After short-term consolidation is expected to retest the 25,736 and 25,766 double top, potentially breaking through on the third attempt, with the next target at 26,200. Short-term support should hold at 25,100. Mainland Chinese markets also rose initially, but later fell, with trading volume continuing to increase. The Shanghai Composite Index peaked at 3,704, but closed at 3,666, down 17 points or 0.5%. The Shenzhen Component Index hit 11,607, but closed at 11,451, down 100 points or 0.9%. The Chinex Index reached 2,513, but closed at 2,469, down 27 points or 1.1%. Combined turnover for Shanghai and Shenzhen markets was 2.279 trillion yuan, up 128.2 billion yuan from the previous day. The renminbi central parity rate was set at 7.1337 to $1, up 13 pips from the previous day. Many companies announced results yesterday. Geely Automobile reported record high first half revenue of 150.3 billion yuan, up 27% year on year, with net profit attributable to shareholders at 9.29 billion yuan. After excluding non-core items like forex gains, core net profit was 6.66 billion yuan, up 102%. Gross profit rose to 24.7 billion yuan with a gross margin of 16.4%. In the first half of 2025, Geely's total sales volume reached 1.409 million vehicles, up 47%, far exceeding market averages, with a market share exceeding 10% for the first time. New energy vehicle sales led by its three brands total 725,151 units, up 126%, with NEV penetration at 51.5%. Due to strong performance, Geely raised its full-year sales target by 11%, from 2.71 million to 3 million vehicles. Meanwhile, Seeker Technology reported a Q2 2025 vehicle gross margin of 17.3%, a record high, with reduced R&D and selling, general and admin expense ratios year on year. Lenovo reported first quarter revenue ending June 2025 at $18.83 billion US, up 21.9% year-on-year, a record high for the period, surpassing estimates of $17.56 billion US and exceeding pandemic-era peaks. All three business segments saw double-digit revenue growth. The Intelligent Devices Group grew 17.8% to $13.459 billion US, the fastest in 15 quarters, with operating profit at up 14.7% to $950 million US. Net profit surged 107.6% to $505 million US, exceeding estimates of $352.8 million US. Earnings per share were 4.12 US cents, up from 1.99 US cents last year. Under non-Hong Kong FRS, net profit rose 21.6% to $389 million US. MTR Corporation reported first half revenue of 27.36 billion Hong Kong dollars, down 6.5% year-on-year. Net profit rose 27.5% to 7.709 billion Hong Kong dollars, with earnings per share at 1.24 dollars. The interim dividend remained flat at 42 cents per share. Recurrent business profit fell 15.7% to $3.391 billion, while property development profit surged 218.5% to 5.542 billion Hong Kong dollars, driven by contributions from Home and Teen Station Phases 1 and 2 and Harbourfront Phases 3 and 5. Underlying businesses profit grew nearly 55% to $8.933 billion, though MTR recorded a $1.224 billion fair value loss on investment properties compared to a $280 million gain last year. China Telecom reported first half operating revenue of 269.4 billion yuan, up 1.3%, with net profit attributable to shareholders at 23.02 billion yuan, up 5.5%. The company plans to distribute 72% of its first half net profit, totaling 16.58 billion yuan, or 0.1812 yuan per share as dividends. CK Hutchison reported a 3.545% increase in total revenue to 240.663 billion Hong Kong dollars under IFRS 16, with underlying net profits up 10.9% to $11.321 billion, or $2.96 per share. The interim dividend was raised to 71 cents from 68.8 cents. In July, a joint venture involving CK Infrastructure, CK Asset, Power Assets, and the group signed an agreement to sell UK Rails with an enterprise value of approximately 28 billion Hong Kong dollars. JD.com reported Q2 non-GAAP net profit attributable to shareholders of 7.394 billion yuan, down 48.9%, but beating market expectations. GAAP net profit was 6.178 billion yuan, down 51.1%. Revenue rose 22.4% to 356.7 billion yuan, exceeding forecasts. JD Retail's Q2 revenue was 310.1 billion yuan, up 20.6%, with operating profits up 37.6% to 13.9 billion yuan, achieving a 4.5% operating margin, up from 3.9% last year. JD Logistics reported first half revenue of 98.532 billion yuan, up 14.1%, with net profit up 13.9% to 2.58 billion yuan, or 41 yuan, 0.41 yuan per share. No dividend was declared. NetEase reported Q2 net profit of 8.6 billion yuan, up over 27% year-on-year, but down nearly 17% quarter-on-quarter. Adjusted net profit was 9.5 billion yuan, up 22% year-on-year, but down over 15% quarter-on-quarter. The dividend was $0.114 per share. Net revenue was 27.9 billion yuan, up over 9% year-on-year, but down over 3% quarter-on-quarter. NetEase Cloud Music reported first half revenue of 3.827 billion yuan, down 6%, with net profit up 132.8% to 1.885 billion yuan, or 8.96 yuan per share. No interim dividend was declared. Membership subscription revenue grew 15.2% year-on-year, with gross margin expanding from 35% to 36.4%. Monthly active users maintained stable growth, with the ratio of daily to monthly active users steadily above 30%. Companies announcing results today include Sands China, China Hongqiao, SITC International, Excletus, CITIC Telecom, Towngate Smart Energy, Xiaocaiyuan, and GenScript Biotech. Innovent Pharma, which began trading today, received 5.34166 times oversubscription in its Hong Kong public offering, with a 0.5% allocation rate for one lot, 200 shares. Yesterday, it closed at 70 Hong Kong dollars in Philip Marks grey market, 274.7% or 51.32 Hong Kong dollars above its IPO price, yielding a paper profit of 10,264 Hong Kong dollars per 200 share lot, excluding fees. U.S. producer prices PPI for July exceeded expectations, with the Dow briefly falling 231 points but closing down 11 points at 44,911. The S&P 500 rose 1 point to 6,468, up for 3 days, while the Nasdaq dipped 2 points to 21,710. The Nasdaq Golden Dragon China Index fell 165 points or 2.1% to 7,584. Alibaba, Bilibili, and JD.com dropped 2 to 3%. Tech stock had mixed performance. Amazon rose 2.9%. Meta and Nvidia gained 0.2%. Apple fell 0.2%. Tesla dropped 1.1%. Intel surged over 7% amid reports of potential U.S. government investment to boost domestic production. July U.S. PPI rose 0.9% month-on-month, up from flat in June, far exceeding the expected 0.2%, marking the largest increase since June 2022. Year-on-year PPI inflation accelerated from 2.4% to 3.3%, a 5-month high, above the expected 2.5%, with core PPI surging to 3.7%. U.S. initial jobless claims for the first week of August fell 3,000 to 224,000, below the expected 228,000. President Trump stated on Thursday that U.S. inflation had reached a perfect number, with almost no inflation, adding that trillions of dollars were entering the U.S. through tariffs. Our stock pick today is Samsonite, stock code 1910. Samsonite announced its interim results for the period ending June 30, 2025, reporting net sales of $1.661 billion, a 6% decrease compared to the same period in 2024, or a 5.2% decrease on a constant currency basis. This decline was primarily due to the unprecedented revenge travel rebound from 2021 to 2023, during which the group's business recovery outpaced the broader market. Recently, however, the group's net sales trend has diverged from overall travel industry growth, reflecting a normalization post-rebound. Increased macroeconomic uncertainties and changes in trade policies, leading to more cautious purchasing by wholesale customers, and weaker consumer sentiment resulting in reduced demand. Despite the sales decline, net sales were still 24.4% higher than the first half of 2019 pre-pandemic. By region, net sales in North America and Asia fell by 7.7% and 7.3% respectively, while sales in other regions remained relatively stable, with Europe posting a 1.6% increase and Latin America experiencing a slight 1% decline. By sales channel, wholesale net sales decreased by 7.4%. In contrast, the group's direct-to-consumer (DTC) channel showed greater resilience, with net sales in the first half of 2025 declining by only 1.6% year-on-year, reflecting the group's strength in building consumer relationships and strategic investments in DTC channels. Consequently, the DTC channel accounted for 39.6% of net sales in the first half of 2025, up 150 basis points from 38.1% in the first half of 2024. The group believes this shift will not only improve overall gross margin, but also enhance the end consumer brand experience and strengthen brand loyalty. By brand, premium brands Tumi and Samsonite demonstrated greater resilience compared to the more value-oriented American Tourister brand. Tumi's net sales in the first half of 2025 declined by only 2.5% year-on-year, with growth of 6.2% in Europe and 18.6% in Latin America. Samsonite's net sales fell by 4.7%, with modest growth of 0.6% in Europe and 0.2% in Latin America. By product category, non-travel product categories, which have lower penetration in the overall business, showed greater resilience, with net sales growing by 0.1% and accounting for 36.2% of total net sales, up 180 basis points from the same period in 2024. This reflects the group's efforts to expand product categories beyond core travel-related products. Notably, the Gregory brand saw a 14.7% increase in net sales, highlighting significant long-term growth potential for the brand and non-travel product categories. Recommended buy price 16.5 Hong Kong dollars. Target price $18. Stop loss $15.7. I do not hold the mentioned stock.